Okay, Deven Choksey of KR Choksey now joins in. Deven, good morning. Thank you for joining in. The last couple of days, we've seen, a rebound on a lot of stocks. PSU Banks in particular were the ones that bounced the hardest after they fell the hardest in the previous week as well. Is there anything that you like in particular from that pack?
Uh, Good morning, Mangalam. Well, I think the PSU banks largely have, I think, few important, developments happened in the last few quarters. Particularly on one side, the liability side, I think, has been corrected. New NPAs, I think, are not happening. At the same time, I think the credit growth in the economy has started picking up. So that is again, I think, working well for some of the PSBs, particularly mid and small PSBs, who have up till now been suffering because of, I think, lack of offtake on the credit growth. Here, at least, I think this particular situation is getting corrected for them. And I think more importantly, most of these PSBs are available at a valuation which is quite, I think, attractive enough. The next trigger, and which is anticipated, could be further consolidation into the PSBs, I think, going forward. Maybe if the budget can lay down the roadmap for that, I think that would be the next trigger, I think, for some of the PSBs to go up. So on one side, valuation remain attractive. On the other side, I think the business conditions, I think, improving for themselves and balance sheet getting repaired, and the possibility of consolidation. All these three or four triggers could possibly drive the prices of PSBs in the interim period. So one can selectively look at some of the reasonably larger size PSBs for the participation into this particular possible rally that we are talking about.
Deven, hi, good morning. So the worst performing stocks this year have been the large cap technology stocks, right? Whether it's Wipro, Tech Mahindra, HCL Tech, all down about 20 to even 50%. In a very long time, I don't think you're going to get this chance to buy, Tech Mahindra and Infosys 40-50% cheaper. Do you think this is a good time to be at least, nibbling into the IT majors, or do you think you'll get better levels?
Hi, Sonia. Good morning. Definitely, I think this is one good opportunity as we see it, because most of these larger companies, particularly the likes of TCS and Infosys, have been signing the contracts for 5 to 7 years of some of the large customers, which means that they are having the visibility of revenue over next 5 to 7 years. Even though on a larger base, I think they are having the program which is 15 to 17% kind of a growth, which is still fair according to me. And in the environment like this, where most of the businesses are basically spending money on IT, largely to create the consumer interface, having created, I think, the enterprise interface in last 20 years, I think now the challenge for most of the corporations is to basically create the consumer interface. And that is what I think Indian IT companies are basically winning the contracts of larger customers. In my viewpoint, I think this kind of price correction, for whatever reason, uh, largely technical, I feel that I think it is better to buy this kind of companies into your portfolio for a reasonably decent set of appreciation. At least I think 15 to 20% kind of appreciation can be ruled out in some of the larger names, particularly the likes of TCS and Infosys, where situation remains extremely favorable to them as far as I think the global business outlook is concerned.
Deven, metals were all the rage yesterday, between 5 and 7-8%. JSPL, Hindalco, Tata Steel, Nalco, and so on and so forth. Is there more here? Do you think this is just pure momentum, sentiment, uplift? Maybe it is, right? But these uplifts, this push can extend sometimes with meaningful rewards. Do you think this is one of those occasions? Metals.
Yes, Prashant. Well, I believe that I think leave aside the technical reasons for a while. I think as far as I think the metal commodity stocks in the market is concerned, but largely the demand scenario for metal is showing signs of improvement. The China factor I think is playing little positive now as far as sentiments are concerned. After opening up China, probably I think we could argue that in 2023, the first half, we would see only the upside improvement into the Chinese economy. So that is one aspect I think which is supporting the argument for metal. That would be more on the consumption side as far as I think the China business goes. But more importantly, when we are talking about renewable as a major theme in the global market, where majority of the countries, including the Western world, will be significantly investing their new money in building the renewable capacities, the metal would be in demand. And at this point of time, largely because either you want to create the solar panel or the wind turbines, or for that matter, hydrogen tanks. Whatever you talk about, I think the metal would be in demand given the kind of demand for the renewables which will happen. So, in my viewpoint, I think the metal should hold the steady regime hereafter. Fortunately, the crude oil prices are remaining in a disciplined range of $75 to $85 to a barrel. And that is where I believe that I think the argument for metal commodity stocks on the margin front also remains in favor. So from that perspective, demand perspective, as well as from the margin perspective, both these aspects are, I think, arguing that metal stocks should remain steady to improved wickets in coming 6 months or so.